If price was a true reflection of demand, then who the hell is standing for delivery? Why did China import more silver in the month of February than any time in recorded records? Ever! Because price is a tool of misdirection. And the big money understands this. So pull back from your emotions, look at things logically, and you'll see that this is setting the stage as the weak and speculative hands have been flushed for a leg higher. Now, I'm not telling you to buy it to get wealthy. I'm telling you to buy it because it is wealth. And the most well-informed traders across the globe, the central banks largely, and whoever the hell is doing it here in the U.S., and in China, bleeding down the Shanghai exchange, and the wicked deliveries out of the LBMA, these people know the playbook.
Global markets often react to headlines, but Andy Schectman argues the real story is happening beneath the surface. While gold and silver prices can swing sharply, he believes physical demand is sending a very different signal. According to his view, when metals are aggressively removed from major exchanges and delivered into private hands, it suggests strong conviction among large institutional buyers rather than market weakness. Andy Schectman, a precious metals expert and market commentator, explains that recent activity on Comex, Shanghai, and other global exchanges may be more important than daily price charts. He points to unusually large silver deliveries and ongoing central bank gold accumulation as evidence that major players are positioning for long-term monetary uncertainty. He says countries are quietly increasing reserves while retail investors focus only on short-term volatility. In his view, price weakness can often be used to shake out speculative traders before the next major move higher begins. He also notes that gold reportedly overtaking dollar reserves in some global reserve trends reflects a broader shift in confidence. If that trend continues, demand for tangible assets could remain strong for years. His outlook suggests that dips in metals may be temporary events inside a much bigger revaluation cycle. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Why are we seeing deliveries on Comex at a level that no one's ever seen before, month over month over month over month over month? And again, let's look at February as an example. February, when the price of gold and silver were getting their teeth kicked in, is a non-delivery month. Typically, it's like January is, February is not, March is, April right now is not, May is. But you can still take delivery. In February, in terms of silver, there was about 25.5 million ounces delivered, which, again, my whole career, Daryl, no one ever stood for delivery. Less than 1% of contracts stood for delivery. It was the anomaly. Now we're seeing massive deliveries. The majority of the contracts that were posted stood for delivery in February. 25 million ounces. That's a lot. That was one of the smaller delivery months in the past 18, but at $70, you're at $1.5 billion. $1.5 billion. But of the 25 million plus ounces that stood for delivery, 39 million ounces or thereabouts left Comex. Left. That's 2 million pounds of silver got on trucks and went by, left the building. Now, that's 160% of what deliveries could explain alone. Who in God's green earth is standing for delivery and taking possession 39 million times, call it $70 even at that point, which was higher than that, but let's just use 70. 39 million times 70, $2,730 million worth of silver just bye-bye and left Comex. So who did that? Who arranged the trucks and the logistics and the insurance, and where the hell did it go? So what I'm saying is, when you see central banks, China for 17 straight months, right? All of these central banks, Poland and on and on and on and on, Brazil, now it's the second largest holding is of everything, is gold right now. Gold has now overtaken dollar reserves in terms of global holdings for the first time ever. So the deliveries by the central banks and by the biggest traders, the most well-informed traders on the planet, you look at the bleed downs in Shanghai, you look at the deliveries out of the LBMA, you look at the deliveries on Comex. These traders ain't you and me. These traders ain't even the people that we think are sophisticated. These are the most sophisticated, well-informed, well-funded traders on the globe that are saying, great, we're going to shake all the speculators out by raising margins and creating volatility and counterintuitive thought. Now you get all these genius talking heads that say, well, gold has lost the anti-correlation to the markets. In fact, when the markets fell because of the war, gold fell more than the S&P. It's lost that inverse correlation. In fact, it has a positive beta moving in the other direction. Don't buy it. Well, that's such a bunch of crap because, again, if you think about it for a moment, that's what they want us to think. Number one, that's management of perception economics. But if that were really the case, then why are the deliveries across the globe accelerating? Because the most well-funded, well-informed traders in the world use that narrative, that speculative, the speculators get blown out by rising margins and a price that's getting hammered, and so they get margin called, and it's lost its correlation. But then they all say thank you very much and stand for delivery at subsidized prices because they're not using margin. Well, that's all ignored. And when we talk about the fact that no one is rushing to treasuries like they used to, that's ignored. And it's convenient when they say, well, rising interest rates, Johnny, well, that's bad for gold. Well, how about the fact that after COVID, interest rates rose the most in a short period of time that they ever have risen ever? In terms of, from like 0.3% up to where we are now. Gold has almost tripled since then, right? In a rising interest rate environment. They ignore that, but, the Fed's not going to lower rates, so that's bad for gold. If the dollar was trusted, if our markets were trusted, if our institutions were trusted, if our country was trusted, then that would be valid. If the dollar was strong and everyone wanted it and everyone wanted our treasuries, that would be valid, as rising rates would attract money into treasuries because gold pays no interest, right? But it ain't true because no one wants it anymore. No one trusts it anymore. It can be weaponized. It can be inflated. We have the fiscal irresponsibility of a third grader in a candy store with mom's wallet. It doesn't work when you have a system that is based on trust that is no longer trusted.
Schectman's main argument is that paper price action does not always reflect physical market strength. He believes rising margin pressure, volatility, and sudden sell-offs often force weak hands out of the market while larger buyers quietly accumulate supply. That creates the appearance of weakness, even as inventories continue tightening. He specifically highlights silver, suggesting that heavy deliveries and metal-leaving vault systems could eventually put pressure on prices if industrial demand remains firm. If this pattern continues, silver may outperform expectations as the market is relatively small compared with global capital flows. Gold, meanwhile, remains the monetary anchor for sovereign buyers seeking diversification away from fiat risk. For investors, the message is patience. Temporary corrections may not change the structural trend if physical accumulation continues in the background. Let's get back to the interview.
That narrative, again, is just stupid. I mean, and that's what they want us to believe, right? And that rates are going higher, so that's bad for gold. Well, how about the fact that for 2-3 years after COVID, rates went higher faster than any time in history, from like 0 to 4+ in a period of like a year, and gold still went to the moon and tripled since then. Here we are since it was 0 in 2021 or whatever, to where we are now, from like 1,700 to almost 5,000 in rising rates. Convenient to ignore that by the mainstream when it's happening. And yeah, they want us to believe that, but if that were the truth, then why are we seeing record deliveries every single month? Why in the month of February did China import more silver than in the history of all recorded markets going into China ever? The month that it got destroyed. Why are we seeing these deliveries in every single month on Comex? So far in April, 18,647 gold contracts at 100 ounces apiece. That's almost $1 billion. And 1,753 silver contracts at 5,000 ounces apiece. So let's do the math there. 1,753 times 5,000 is 8,765,000 ounces. And let's multiply that times... oh gosh, silver's up almost $4 right now. It's at 79.20. So let's multiply that times 79. That's $692 million worth of silver have been delivered so far in the first week or so.
Oh, $1 billion or
yeah.
$1 million? Yeah.
692,435,000. Okay. But by the end of the month, because that's only for the first, what's the date today? It's for the first 2 weeks. By the end of the month, we'll be way over $1 billion. And it's been way over $1 billion every single month. In February, which is a non-delivery month, 25 million ounces delivered, 39 million ounces leave Comex. Leave. 160% of what was delivered left. 2 million pounds of silver left. Billions of dollars worth left. Who's running logistics? Where are the trucks coming from? Who's doing that? Where's it going? Who's paying for it? 2 million ounces leave the eligible category a few Fridays ago. Those aren't even the bars that are available for sale because no one trusts the system anymore. The narrative that war pushes up the price of oil, which pushes up the CPI, which pushes up inflation, which then makes no rate cuts. Well, that's bad for gold. Well, again, if people trusted the dollar and the treasury, it would be, but they don't. This is the MOPE, Management of Perception Economics, that my dear departed friend Jim Sinclair used to say. We knock the price down to control the narrative and then stand for delivery because we don't use margin. They knocked off all the speculators, freaked everybody out, and then you see every single month, even in the month of February when the price got hammered, huge deliveries here on Comex and actually leaving the exchange, the largest silver deliveries in the history of recorded markets in China that month. And I'm telling you, the central banks haven't stopped, and nor have the deliveries on Comex every month for 18 months. That betrays all of the mainstream narrative, which is still using...
They saw it as a bargain.
That's right. Let's shake them from the trees. We'll jack up the margin rates. Even the IMF came out and said, it was either the IMF or the BIS, that this was not a fundamental decline. It was structural, largely blamed on rebalancing of levered ETFs and margin increases. They said it is not fundamental. It's structural. In other words, it was engineered. Jack margin rates up and rebalance the ETFs that were way out of whack because of silver's rise, and bang, create selling, beget selling, beget selling, get margin call, margin call, margin call, I'm out. And it destroyed all of the, like for the refining in this country, the refiners had to bail and say, we can take no new business. They were getting margin called every day. So the structural, engineered price decline fell right into the hands of the big traders. That would be the sovereign wealth funds, the governments, including the United States, in my opinion. All of these countries that want physical possession, that don't use margin, they said, thank you, we'll stand for delivery, bye-bye, at wickedly subsidized prices because of the leverage unwind, which, according to the highest, most powerful banks on the planet, was structural, not fundamental. So yeah, it's just a bunch of phooey that the mainstream media, which lacks any integrity or journalistic work effort or work ethic, they just sidestep. If price was an indication of value, then why the hell are the most well-informed traders on the globe standing for delivery across the globe nonstop? They use price as a tool of misdirection. And so, yes, fear is the most powerful motivational force on the planet. And when people get scared, they act irrationally. They dump at the worst possible time, which drives down the price, which falls right into the hands of those standing for delivery who have the information and the funds. That's exactly what's happening. And yeah, even the well-informed alternative side of the table, our side, these people are not immune to the emotional. Look, I'd be lying if I said I wasn't. I've been doing this 36 years. I've lived through every downturn we've ever seen in the last 3.5 decades, and it still bums me out. But I'm at least wise enough through watching it all and understanding the deliveries and stuff to understand where this will ultimately go. But yeah, it messes with you. You're like, again, it's like, I'd be lying if I said otherwise. But you have to be able to separate emotion from rational, logical thought. And if you can do that, it makes the emotions worth less than emotion is important, right? Fear is important at telling you, hey, danger. But you have to try and understand, is this manufactured danger or is it organic? Is it real? And I think the manufactured danger, you can see through it if you look closely based on the deliveries across the globe, not just here, but in Shanghai and on the London Metals Exchange, et cetera. This run is not over, not even close to being over. And if it were, you would see the central banks dumping. You would see not deliveries on Comex, you would see the Comex being flush with metal as everyone was selling it back and getting out, not standing for delivery and taking it out. About $60, 4,800, and silver's up $4.50 to roughly 79. So, yeah, I do. I mean, you got all the big players calling, a lot of them, for $6,000 or higher by the end of the year. Could it happen? Sure, why not? Typically, you would expect to see things really take off come September, October. That's usually when you see things move. But look, the fundamentals would support it, certainly. Nothing has changed. If they're right about saying it was structural, not fundamental, nothing's changed. And all of these banks, Bank of America, you got the chief investment officer of Morgan Stanley, who earlier in the year said, sell half of your bonds, the 60-40 rule that's broken. BlackRock just said the 60-40 rule is broken. The chief investment officer of Morgan Stanley said that 60% stock, 40% bond is broken. Sell half your bonds and buy metals. Well, BlackRock is doing the same thing. The lead analyst for Bank of America, Michael Hartnett, said, no, you should have 25% of your wealth in precious metals. Their head gold trader just came out and said that he could see silver between $130 and $309 by the end of the year. So, yeah, I mean, the banks are still calling for it. The logic, if you can separate the emotion, says, yeah, it should probably already be there based upon the demand and the dollar creation and the manipulation and all of the stuff. Sure, why not? But I don't focus on price, Daryl. I look at the fact that if you hold it long enough, the bull market will take care of your entry. The bull market will push this much higher.
Yeah.
Focusing on prices is dangerous, and I think you put yourself out on a limb, but I would say prices will go higher than people think possible.
The main takeaway is gradual changes in financial confidence. Central bank gold buying, silver movement, and debt worries suggest institutions are preparing for uncertainty. Large, informed buyers taking delivery signals a critical market trend. If his thesis proves correct, the next phase may not simply be higher prices, but a re-rating of what real money means in a debt-saturated world. Gold could remain the preferred reserve hedge, while silver may benefit from both monetary demand and industrial necessity. That combination can create explosive upside during supply stress. Of course, markets are volatile, but long-term investors focus on trends in ownership and physical flows. Schectman believes these are the real indicators. Share your thoughts in the comments below. If you found this analysis useful, please like this video, subscribe to the channel, and turn on notifications for more updates.